February 22nd, 2024, 1 year ago. That's the day when a fourth generation entrepreneur and the sixth richest businessman in India decided to step into one of the most profitable and tightly controlled sectors in the Indian business history. I am talking about Kumar Mangalam Birla of the Birla Group, who announced the launch of Birla Opus, their grand entry into India's 80,000 crore decorative paints industry. Now, this isn't just another business tycoon dabbling in the new industry. This looks like a power move. In fact, I'd go as far as calling it the Geo movement of the paints industry. Think about it. There's a seasoned business giant with deep pockets entering a market where the top three players control a big chunk of the industry. Sounds familiar, right? So what makes this such a big deal? Well, there are two things that caught my attention when I did my research. Number one was the player entering the space, which was the Birlas. Second was the industry they were entering. Let's break it down. Let's start with the challenger here, Birla Opus. The Birlas are not trying to play small here. They're walking into an industry with guns blazing, and their strategy is go big or go home. Just look at these numbers. 10,000 crore investment. That's how much they're pouring in, with 8,500 crores solely into the manufacturing capacity. Number two, 1,332 million liters per annum. That's the total production capacity they are setting up across 6 mega plants. For context, that's more than Berger Paint's current capacity, which they have built over a century. In one swoop, Birla Opus will add 40% of the industry's total capacity. Number three, a 10,000 crore revenue target. If they pull this off, they'll become the third largest player in the industry almost overnight. And number four, 50,000 dealers already on board. And they're not stopping there. Their plan is to build the second largest dealer network in the country within a year. Clearly, Birla isn't here just to take part. They're here to take over. Now, let's talk about the industry they're trying to break into. The Indian decorative paints market has been an oligopoly for as long as we can remember. The top three players cumulatively held more than 80% of the market for more than a decade. Now, for those of you who don't know, oligopoly is a market where few big players dominate the industry, controlling everything from pricing to supply chains. For investors, oligopolies are a goldmine. Stable profits, market control, loyal customers, and they're one of the best performing sectors in the stock market. The paint sector is one of them. You need proof for that. Since 1999, Asian Paints has given investors 18,500% returns. Berger Paints had delivered 33,500% returns. These are some of the biggest wealth creators we're talking about in the Indian stock market history. But there's a reason for that. Because new players never survive in this sector. Not one, not two, but countless companies have tried and failed to break into this market. Here's a list of those who tried and failed. Number one, Sherwin-Williams in 2010. One of the biggest global paint companies, they bought Nitco Paints to enter India but couldn't crack distribution. 3 years later, they ended up selling their business to Berger and left. Number two, Imperial Chemical Industries in 1990s. This is another global giant. They struggled with high costs and weak market penetration. Eventually ended up selling their Dulux brand to AkzoNobel in 2008. Number three, Shalimar Paints, the oldest Indian paints company. Despite 120 years in business, they never managed to shake the dominance of Asian Paints or Berger. And finally, number four, AkzoNobel, the fourth largest player in India today, is rumored to be trying to sell off its business. The likes of Pidilite, JSW and Indigo are circling around and ready to place their bets. So here's where we stand. On one side, we have a business empire, as serious as the Birlas, throwing in more money and scale than the industry has ever seen. On the other side, we have a fortress-like industry, where every new entrant has struggled, some even with global muscle behind them. So who wins? That's the answer I am looking for today. And I'm not alone. I will take help of two of India's smartest fund managers for this. Hi, this is Kashish, and this is a new show we're starting with Zerodha, where I go down deep, weird, and sometimes unnecessary but totally fascinating rabbit holes about sectors that keep me up at night. I chase the questions that have no easy answers. I spend hours digging through research, and I'll shamelessly be bothering a lot of experts until they give me the good stuff that I want. And guess what? All of this is sponsored by Zerodha. We don't have a name for the show yet, so why don't you guys help me find a name for it? Now, my boss thinks that I shouldn't have started the series with something as uninteresting and as soul-sucking as the paint sector. He's 100% convinced that this episode would be a snooze fest and nobody would watch it. So here I am, all hyped up to prove him wrong. Grab your chai or coffee, let's begin. Before we dive into the battle itself, let's take a step back. Because this isn't just about one player trying to shake things up. This is about an industry that has remained nearly unshaken for decades. Here's the real question. What makes the Indian paint industry so special? Why is it that the top players make more money than anybody else combined? And why is it that despite multiple attempts, both foreign and domestic, nobody has managed to challenge them? The answer lies in moats. Now, moats is actually a term from medieval warfare era, but somehow it found its way into the world of investing thanks to none other than our guru, Warren Buffett. What is a moat? Picture an ancient castle surrounded by deep, wide trench filled with water. Its purpose is defense. It makes nearly impossible for enemies to attack the castle, keeping those inside safe. Buffett looked at this and thought, hey, businesses kind of work in the same way. He coined the term economic moats in his letter to the shareholders in 1986. It is a fancy way of saying a company's competitive edge that protects its market share and profits from competitors, just like a water-filled moat protected medieval castles. And this is the reason why market leaders in the paints have continued doing what they do without being seriously challenged. Their moats are deep, their castles are impenetrable. Now that leads us to the next natural question. How do these moats even come into existence? So far, we know that moats exist and that they've helped these paint companies to dominate the industry for decades. But how do they actually form? That's the question.
See, to begin with, moats get created and deepened by companies who might be leaders or upcoming challengers, right? So the existence of moat in any industry is actually an outcome of how the players in that industry have behaved in the past. Secondly, every moat is trying to solve a pain point in a manner that others can't solve, right? So there are two facets to it. One, there has to be a pain point, otherwise you can't build a competitive advantage around it. Secondly, it has to be a deep enough moat so that others can't replicate, and hence the solution is sort of monetizable, or return on capital employed is an outcome of the solution, right? So there isn't, in that regard, in my view, there isn't anything special about paint industry, but there is a lot special about how the players in this industry have behaved over the last 30, 40, 50 years, which has led to this industry being a high ROC industry for the more deeply moated companies.
Okay, so clearly these companies have been doing something right. Certain actions that have helped them build and strengthen their moats over time. But what exactly are these actions? What are these companies doing that makes their moats so impenetrable?
Now, the moats that existed for the longest time in this industry, the biggest moat was around supply chain velocity, right? Why was that a moat? If you see, paint is a chemical, chemicals are voluminous. Typically, rough number, 10 times more voluminous than, say, an FMCG product. Now, if a voluminous product has to be transported through the length and breadth of this country, it becomes challenging. What Asian Paints did, in addition to just being a player here, was they changed the architecture of this industry by removing layers of the channel. So now the voluminous product in this industry is transported to the last mile by the manufacturer directly, rather than via wholesalers, distributors, C&F agents, so on and so forth, right? Second piece is Asian Paints also compressed the margins that the dealer makes. In a way, let me put it this way, free markets ensured that margins that dealers retain are wafer thin, right? So although the MRP is 15 to 20% higher than what the dealer sells the product at, and Asian Paints doesn't force the dealers really, I think, to sell the product at 15-20% discount to the MRP, but the competitive forces have meant that dealers retain wafer thin margins. Combine these two, what do the dealers make money on? It is inventory turns, right? Asian provides it, Berger is a close follower.
So now Rakshit mentioned inventory turns, but what does it exactly mean? Let's break it down simple si bhasha mein. Imagine you're a paint dealer. You've got a shop to run, expenses to cover, and a family to support. At the end of the day, you are in this for money. And to make money, you have two choices. A, sell paint at a high margin. Or B, sell a lot of paint in a short amount of time. That second part of selling paint quickly and frequently is called inventory turnover. Inventory turnover is simply the number of times a dealer sells and replaces their paint inventory over a period of time. So even if a dealer is making lower margin per sale, they can still earn overall more if they are selling paint fast enough. That's why for dealers it's not always about how much margin they can make per bucket of paint, but rather how quickly they can move inventory and keep making sales.
Inventory turns are so high that typically in a day, at least 2 to 3 deliveries for the top 500, 600 cities of this country. 2 to 3 deliveries a day Asian Paints would be doing to most dealers. Now that's a very high frequency supply chain, right? So this is why I'm talking about velocity of the supply chain rather than just the prevalence of the supply chain. And for the dealer, the ROI is far less oriented towards margin, far more oriented towards inventory turns.
So now we understand that distribution is massive moat in this industry. But as an investor, how do you actually measure this? How do you compare one company's distribution strength to another's?
So there are four sub points that I would want to cover within the distribution. So one is the dealer footprint that they have. So Asian Paints, who is the market leader here, has about 160,000 dealer outlets, whereas the second player has about 30 to 40,000 kind of a footprint. So over the years, the market leader has only expanded the footprint with entering into tier 3, 4 towns, and that has helped over a period of time. Secondly, tinting machines plays a very, very important role in paint dealers, because you literally have space for maybe 2 tinting machines within your small dealer workshop. And if you don't have a tinting machine of a player, then you will typically not sell their products. So that has been an advantage for the existing players, especially the market leader.
Now Raj mentioned tinting machines, but let's take a second to understand what they are, how they work, and why they're so crucial. Paints is a high volume product. We all know that by now. But here's the catch. It comes in thousands of varieties. Just for example, Asian Paint alone has 1200 different types of paints, 2300 different color choices. Now imagine you're a paint dealer. Could you physically stock all 1200 paint types and 2300 plus colors in your shop? Absolutely not. Even if you tried, you'll only be able to store maybe one bucket of each variant, which is useless because customers usually need more than just one bucket. So what do? You call the company and wait for their delivery. That's also not practical. This is where tinting machines come in. Tinting machines are large mixing machines that allow dealers to custom mix paint on the spot. Here's how it works. The machine precisely measures pigments, which give color, and the base paint. It mixes them right there at the shop and produces the exact shade the customer wants instantly. This means dealers don't need thousands of paint variations. They just need one tinting machine, a few base paints, and a selection of pigments. And boom, they can create any color on demand. This is why every paint company wants their tinting machines inside a dealer shop. And once a dealer installs a company's tinting machine, it's game over for competitors. Why? Because A, limited space. A shop can only fit 1 or 2 tinting machines at max. Number 2, dealer loyalty. If your tinting machine is in the shop, the dealer is incentivized to push your brand over others. And number 3, high switching costs. Replacing a tinting machine is expensive and disruptive, so dealers rarely switch brands. Now back to Raj.
That has been an advantage for the existing players, especially the market leader. Third is a manufacturing footprint. So closer you are to the customer, closer you are to the warehouses. That helps because paints in itself is a voluminous product. So transportation costs help in terms of higher margins if you are nearby the consuming state. So just to give you an example, the recent entrant into the paints market has started with 6 manufacturing plants, and all 6 of them are very close, 100-150 kilometers away from the metro cities, top 6 metro cities that are there. So that will help them in at least tap into these metro cities where a majority of the demand is there, and then over a period of time they will start entering into rural towns and tier 3-4 towns.
So now we know what makes the incumbents so strong. Let's see how Birla Opus, our challenger, measures up against them. First, dealer network. Unlike most new entrants, Birla didn't have to start from scratch. You see, the Birlas already run Ultratech Cement, which sells Birla White Putty, a product that competes in lower end of the paints market. Here's where it gets interesting. Birla White already has an existing network of 60,000 dealers, and 70% of them also deal in paints. This means Birla Opus already has a ready base of 42,000 dealers from day one. And they're not stopping there. They plan to scale this number to 50,000 by the end of FY25, which would put them close third place in the industry. Second, tinting machines. Now, we already discussed how tinting machines are a huge moat in this business. 70 to 80% of dealers of existing players already have them. So, how does Birla plan to break in? By playing it smart. Opus is giving away compact next-gen tinting machines for free. Yeah, for free. And here's the catch. These machines are 40% smaller than traditional tinting machines. This solves a major problem. Dealers often don't have enough space for bulky machines. Plus, it's zero cost for dealers, making the switch even more tempting. By solving the space constraint, they're making it easier for dealers to say yes, which could be a big disruptor. And finally, manufacturing. Raj already explained how Birla has strategically placed its manufacturing plants closer to urban centers. This means that Birla Opus can get products to urban dealers quicker than competitors whose plants are further away, a huge advantage in this high-volume, fast-moving industry. Now, while researching further, I stumbled upon another factor that has played a massive role in building distribution efficiencies in this industry. And surprisingly, it has to do with supercomputers. Let me explain. We already know that a key to winning this industry is getting paint from manufacturing plant to dealer to customer as fast as possible. But imagine this. What if you could predict which dealer will need which type of paint in future before they even know it themselves? That would mean faster inventory turns, less time wasted in reordering stock, and more money for the dealers. That's exactly what Asian Paints figured out over 50 years ago. In 1970, Asian Paints made a mind-blowing decision. They bought India's first ever supercomputer even before ISRO or IIT Bombay. At a time when most companies were relying on basic spreadsheets or even pen and paper, Asian Paints was collecting and analyzing vast amounts of data of consumer buying habits. This gave them an insane advantage in demand forecasting. They knew what dealers needed before dealers knew it themselves. They sent stock ahead of time, cutting delays. They made inventory turnover even faster, making dealers even more profitable. Now, this raises an important question. Is this still a source of competitive advantage today, when every company now has AI, big data, Salesforce for demand forecasting? Well, experts have mixed opinions. Rakshit believes that pioneers like Asian Paints have 40-50 year head start in demand forecasting data, which makes them significantly better than competitors at predicting demand. But Raj isn't entirely convinced.
It does exist to some extent, so it is not as prevalent as it was 3-4 years back, because everybody is now into data analytics, AI, and everybody has the data now. So 3-4 years back, it was more of a competitive advantage for the market leader, but we have seen the latest market entrant doing the same thing now. So given that capital is not a constraint for the newer players, it may not be that much of a problem going forward. So the existing players still replenish about 12 to 24 once in 12 to 24 hours, whereas the market leader does in 4 to 6 hours is what they claim. So when you talk to most of the dealers and distributors, you will get this data point, but whether this will remain a competitive advantage going forward or not remains a question mark, because the latest market entrant is also very tech savvy. At the same time, they have the capital that they require to do this data analytics, and they also have the warehousing in place, manufacturing footprint in place that will help them replenish the dealer's inventory as fast as they would want to.
So far, we've talked a lot about distribution from manufacturers to dealers. But then I had a realization. I too am a target user for paints. I've had my house painted before. And as I thought about my own experience, I realized there's one crucial link in the distribution chain that we almost forgot: the painter. Think about it. When you're getting your house painted, whether it's a new build or a fresh coat on the old one, how do you actually buy the paint? Do you walk into the paint shop, pick a brand and buy it yourself? Not really. It's not like buying a new office t-shirt where you personally go, choose and purchase the one you like. Instead, you hire a painter or a contractor to do the job for you. And here's the thing, they arrange labor, they help you choose the right paint, and they buy the paint for you. Which got me thinking, am I, as the consumer, even making the buying decision? Or is it the painter making it on my behalf? I mean, if my painter insisted that I choose brand A over brand B, would I really argue with them? Probably not. Because every brand in the market has every possible shade and finish you could think of. And let's be honest, I as a consumer can't really tell the difference between their quality. So if my painter recommends a brand, as long as it fits my budget, I'll go with it. Raj beautifully explained where the painter fits into this whole entire distribution channel. Hear him out.
Paint companies have to be very, very careful in managing three stakeholders. So one is the dealer network. So there they can influence them by dealer margins, by quicker replenishment of inventory, return on investment that the dealer can get. Second is the influencer, where the painters and contractors come into play. They play a very, very important role, and there they can probably do some training programs for them, or have some incentives in place, take them on foreign tours if they buy a certain amount of paints and all that. Those kind of incentives work for the influencers. And third is the customer, where brand plays a role, and at the same time it should be within the budget of the customer who is making his own house. So these are the three stakeholders that the paint companies need to be very careful about and balance all the three stakeholders' interests.
Now, listening to him, this raises even bigger questions. Do I as a consumer have the least say in the buying decision? Who actually has more influence then? Is it the painter or the dealer? And finally, if that's the case, what about branding? Does this mean that all the ad spend and marketing campaigns from all of these paint companies, they're pointless? Was the Asian Paint's famous mascot, Gattu, a failed experiment? Now I had even more questions. Rakshit came to my rescue.
Marketing spend budgets per se don't create moats in this industry. Having said that, let me classify your answer into few different parts. For standard paints, the decision maker for the end customer is actually the painter, because the end customer is choosing the shade, the painter is bringing the shade card. Right? Shade card belongs to the company. Shade is there within everybody's shade card. Right? So for the end customer, the decision maker is the painter. Interestingly, for the painter, which shade card he will bring, the decision maker is the dealer, because the painter is running labor as his capital employed. He needs to sweat that labor harder. Labor shouldn't be sitting idle. Unavailability of paint at the nearby dealer on demand leads to the labor sitting idle. So the painter typically will bring the shade card where supplies are most readily available with the dealer. So in a way, for the painter, it's the dealer. This is for the standard paint, and hence for the standard paint product sales, marketing budgets have only a limited runway in helping create competitive edge. When it comes to premium products, let's say the wallpapers here, or textured paints, that is where the end customer is far more involved, right? So the higher up you go in the hierarchy of premium paints or premium applications like wallpapers, end customer involvement increases. But for basic stuff, customer leaves it to the painter. Typically the painter decides basis nearby availability at the dealer shop. Now, who's doing the best job? So obviously branding, marketing helps to an extent, for sure. That's where Gattu also helped. If you go by who's got Shah Rukh Khan on the advertisement, who's got Deepika Padukone on the advertisement, I think all of them have got cricketers and Bollywood stars. So nobody is using an inferior quality advertisement content in this industry. But again, that has not created a differentiation really. It is a good to have, not a need to have piece in the whole equation.
By now, you probably have a fuzzy but clear enough idea of how the paint industry works, how deep and wide these moats are, and why nobody has successfully challenged the top players. Now it's time for the second half of the story, the part where we focus on Birla's entry and how the industry will or might evolve because of it. We will start by first answering a simpler question. Why did Birla even decide to enter paints in the first place? The answer has everything to do with what we call adjacencies in business. Adjacencies refer to areas of expansion that are closely related to companies' existing products, services, or markets. Think of it like this. Imagine you run a tea stall. You sell amazing chai and have a huge base of loyal customers. Now, people love coming to your stall for tea. But while they're there, won't they also love to grab some fritters or samosas? Not only would they be happy, but you'd be making more money without much extra effort. Even better, you already know how to make great samosas. So why not expand into this closely related business? That's exactly what Birla did. Being a major cement player, which is a building material, expanding into paints made perfect business sense.
The thinking amongst all the companies that you talk to amongst the building material space is that if you are making a new home, you will buy all the building material products, and more products you have within your bouquet, the customer will not go out. So if someone is coming to buy faucets and we can give him sanitary ware also, well and good. At the same time, we can give him plumbing pipes also, well and good. That customer doesn't have to move out, he can get everything within one basket, one company, and that will benefit the end customer. But we have seen that over the years it's not been that easy. So traditionally, whatever advantages that most of these players had, so for example, someone who is more into sanitary ware has found it difficult to enter into, say, tiles or faucet ware, whereas someone traditionally who has been strong in faucet ware has found it difficult to enter into sanitary ware. Same way, we have seen adhesives player enter into paints, and here it has found difficult. Paints player has found it easy in terms of waterproofing, because it's kind of the synergies are there in terms of waterproofing. But if you look at other segments, home services or other kitchen segments or bathroom fittings that they have entered into, it's been a little difficult and for them to get going. So I would say that everybody is trying to enter into each other's territories, but it's been very difficult to get into it.
So you think there is a lot more nuance to it than just the fact कि अगर एक बंदा अपना घर बना रहा है, you want most of out of their pocket by offering different variety of products at the same. So logically that makes sense, but execution has been very difficult for all these.
Also, most of these segments do a lot of outsourcing for manufacturing. So the competitive advantage is not there in terms of manufacturing. The product is same across the industry. It's just that your label is there on that product and you sell it out. So the competitive advantage comes in terms of what pricing you can give the dealer, how much incentives you can give to the dealer to push your product, and how quickly you can do your inventory turns and replenish the products at the dealer end. So that's the competitive advantage. And once you have scale, you can do that. If you are subscale, then it's very difficult. So that's why you see that, say, a large sanitary ware player who is trying to enter into faucets has not been able to crack it, because the faucets is at a subscale level where they are not able to provide same level of incentives that the market leader is providing. Same way it's been across sub-segments.
So yeah, it makes business sense for Birla to enter the paints industry. But the fact remains, many other building material players have tried entering adjacencies before, and their track record of success isn't great. Does that mean Birla will also fail? Not necessarily. But history doesn't favor them. And while we can't predict the future, we should analyze and focus on the present. And honestly, the present, it worries me too. Let me explain why. So there's this book called Capital Returns by Edward Chancellor. In that book, an economic concept of capital cycle is explained. It somewhat goes like this. Some businesses make high profits in industry. More money flows in because investors chase high returns. Business owners here see success and expand to grow even more. This seems like a smart move. But expansion takes time. While new factories and products are being built, no one notices that too much supply is on the way. When the new extra supply finally hits the market, prices drop and profits shrink. Investors lose interest, companies struggle, and some even shut down or merge. Fewer companies remain, setting them up for even higher profits in the future. This sounds brutal, right? Now the big question is, can this happen in paints? some experts are highly confident it will.
No, definitely going forward it will become a constraint because not only the new player is coming up with a huge capex, even the existing players are doing a lot of capex. So if you see the market leader, they are increasing the capacity by 45%. If you see the top 4 players, they are increasing their capacities by about 35%. And 40% of the existing capacity is being brought in by the newer players. So all over the place the capacities are being increased, and at the same time demand is not going to shoot up. So definitely we will see some pressure in terms of return on capitals that most of these companies can enjoy, and at the same time I see consolidation happening within this space where top 3-4 players would garner a lot of market share again going forward. So we have already seen one foreign player wanting to exit the paints in India. We'll see who acquires that, but again we'll see a lot of consolidation happening within this space.
Okay, so Raj has some valid points. But has the paint sector ever gone through this before? Rakshit has something to say.
If you see how the industry, in this case paints, has behaved in the past here, demand has not been too cyclical, because remember 80-85% of the paint industry's decorative revenues come from repainting, right, or 75-80%, it's repainting. New construction is hardly a quarter or a fifth of the industry. New construction is far more cyclical, repainting is less cyclical, right? So because the demand has not been so cyclical historically, what we've seen is 50% capacity expansion happen once every 6-7 years, but not lead to profit pools shrinking. So I'll give you 2 instances. FY10 to FY12, there was a 50% increase in the capacity of organized players, right? FY18 to 19, in a single year, Asian, Nerolac, Berger, everybody expanded capacities by 50%. So 40, 50, 60% jumps in industry-wide capacity over a 1 or 2 year period have happened in this industry periodically. But as I said, neither after FY12 nor after FY19, in the subsequent couple of years, did we see profit pools shrinking, because the capacity expansion was done bearing in mind the need to be prepared for the next 7 years of upcycle in a non-cyclical demand environment, right? And hence there was no irrationality. Demand kept growing after FY12, after FY19, and capacity utilization levels kept going up for everybody, different rates for companies growing market share at different pace. So that's the experience so far. So it's not that capacity expansion of 40, 50, 60% in a couple of years hasn't happened here. Having said that, what has happened in the last 2 years, 1 year, is different from these cases. Why? Because here, this time, the capacity expansion for the industry, which is I think 20 to 30%, if I'm not wrong, it has happened not through incumbents largely, this is through a new player. What's also very interesting is, this has happened when, very interestingly, India's consumption and home building material industry have gone into a down cycle of demand. A slowdown which didn't exist in the previous capacity expansion instances, right? So as a result, it will be interesting to see how the unit economics and the capital economics plays out this time in the industry.
Now, if we look at business history, trying to forecast what will happen is very tricky. But based on my own research, and this is a very personal opinion, this is the highest competitive intensity the industry has seen in a very, very, very long time.
No, definitely this is the highest. So we have seen some players entering the markets and exiting quickly, but we have not seen such a big player with such a big balance sheet coming in and attacking the whole country all at once. So we've seen some regional players starting with a small territory and then expanding into newer territory.
Now, if this capital cycle theory holds true, there's one unavoidable consequence. Return on capital employed, that's ROCE, across the industry could take a massive hit. And if that happens, investors won't be happy. How will this play out? Falling returns could happen in two ways. A, margins shrink. If companies lower prices to fight for market share, their profits will drop. Number two, market share might take a hit. If margins are held, then incumbents will lose their customers. Either way, investors lose. And when this much capacity expansion happens, it's not a question of if, but a question of when. When will the ROCE fall? So how will the existing giants prepare for this? What happens when business wars like these break out? Raj gave me some serious lessons on business wars and what happens when giants as huge as Asian Paints and Birla Opus clash.
So the initial reaction, if you see history where new competitors have come into a oligopoly industry, we have seen that the initial reaction is to protect the market share by protecting the volumes and grow the volumes to some extent. Pricing can be down for a short period of time, and then eventually once the consolidation happens within the industry, again it becomes a oligopoly or at least a 4-5 player kind of a market, then you can concentrate more on pricing power and earning return on capitals which are as per what you wanted it to be. But the initial reaction, at least in the short term, is to protect your territory, protect the volumes that you are doing, and try and sell whatever you can in the market and not let the new player garner that much of a market share.
And why do you think companies do that? Is there any reason behind this competitive strategy that they apply whenever there's competition coming?
Sure. So companies need to be adaptive. So if you stick to your pricing and lose on your volume growth, then you may be out of the market 4-5 years down the line, where the new entrants will take a larger and larger pie of the industry. Whereas if you are not losing out on the volumes and just suffering for the short term in terms of margins, then that may help eventually for you to gain back the pricing and then eventually get back to the leadership position within the industry. So that's how.
So what you're suggesting is that risk of losing market share has a more structural consequence to your business compared to margin compression, which can still be a very short to medium term impact.
Correct. So short term pain may be fine for a lot of promoters as long as they are not out of the industry, as long as they are surviving within the industry and then eventually get back onto their growth path.
Now, as I kept digging more, I stumbled upon one last rabbit hole in this entire story, and it could change everything. You see, the Birlas have been in the chemicals and cement business for decades. These are capital intensive industries, and historically, their businesses have generated 10 to 15% return on capital employed on an individual basis. On a blended level, even lower, definitely below 15%, which means the Birlas come from a place of lower expectations. For them, if their paint business even manages to hit a 20% ROCE, they'd be extremely happy because that's way better than what they're used to. But here's the problem. 20% ROCE is not the industry norm. Asian Paints and Berger have been enjoying super normal ROCEs for years, operating in 30, 40, even 50% ROCE range. Which got me thinking, and I have a hypothesis. So hear me out. If the Birlas are comfortable with 20% ROCE, they have the willingness, the capacity, and the incentive to bring the ROCE of the whole industry down. The willingness because they aren't bound by ultra high return expectations like incumbents. They have the capacity because they have the financial muscle to sustain lower ROCE level for years. And finally, they also have the incentive. Even a 20% ROCE, their paints business would still outperform their existing portfolio of cement or chemical businesses, which means they could potentially drag the entire industry down to these levels. If they are okay with 20% ROCE, why wouldn't they be willing to operate at that level, forcing everyone else to adjust? And that would annoy all of the incumbents. This was my hypothesis, and I needed to run it by some experts. Here, Rakshit gave me an answer.
So every merit to an argument here will have to go via what makes economic sense for, again, the painter, the dealer, and also value add to the end customer, right? As long as offering a proposition via low ROC adds more value to the painter, dealer, and customer, there is a disruption prospect here. Having said that, let me also just put it in this way. Broadly speaking, you can divide competitive intensity across economies into two categories. One where moats aren't too deep, they aren't really insurmountable, and capital is a very big substitute to the shallow moats that have existed so far, right? And the other where the flip side, a mirror image of this exists, right? How will the paint industry behave? Again, depending on how the players behave in terms of offering that value add, will be a determinant of this answer. Let me give you some data points now. So Asian Paints has had 35% return on capital employed for more than 30 years at least, pretty consistently. Berger has had around 10% lower. That 10% lower ROC of Berger is actually an outcome rather than a way for Berger to gain share from Asian. Right? Go further ahead. Nerolac in the last 20 years has seen its return on capital fall from 20-25% down to closer to 15%. It is also a company losing market share the most in the last 10 odd years, right? During the noughties, it was Dulux, Akzo Nobel. During the teens, it was Nerolac. These market share losses have come for these companies with declining ROCs. So if lower ROCs were a way to gain market share necessarily, then actually Nerolac today has 20% lower ROC than Asian, right? It should have, by that logic, a stronger competitive edge or stronger value add to offer to the dealer, the painter, the customer, etc. Right? Which is where again the question comes: is Asian Paints going to be able to sustain superior value adds with 35% ROC, or will Asian Paints have to compromise on ROCs to sustain the superior value add? Or actually, even after compromising the ROCs, Asian Paints' value adds will not be sustained in a superior way. That's really the question. I mean, ROC by itself is an outcome. It is representative of a moat. It doesn't help destroy the moat. So lowering the ROC doesn't help kill higher ROC competitors necessarily, right? But having said that, in many industries, you offer 20% lower price, value add increases immediately, because the value add is very much linked to margin, the price, and price wars are fruitful, right? So I can again maybe give you some other types of examples. So in telecom, for instance, in airlines, for instance, lower price wins the customer. Lower price brings lower ROCs. So lower ROCs can actually coincide with higher market share, right? And hence, incumbents with large balance sheets into the airline industry, let's say, who are willing to burn a lot of capital initially, the more capital burn that they do, the more market share they will gain, right? But that doesn't sustain once the capital burn stops, point number one. And that doesn't work in industries where value adds are beyond just price, right? So let's take one level superior example to, in terms of moats, superior in terms of moats to the airline, the telecom piece. Let's go for Patanjali versus Unilever. Massive price wars, right? Unilever did go through margin compression for a couple of years. Profit pools did get shrunk. But once the capital burn of the disruptor reduced or stopped, the market shares and profit pools for a Unilever, they went back up, right? So that's one level superior. And then there are many examples in the top quality moat piece. So far, pre-Birla, paints has been one of those examples where a Sherwin-Williams came and offered, I remember Capital employed a Sherwin-Williams in 2007 when they acquired Nitco Paints, was $1 billion, 5,000 crore at that time I think was $1 billion. It was not a very lower number compared to Birla today, right? And it didn't work, right? But never say never. Maybe in the case of Birla it works. But the point I'm trying to make is, just because high capital influx is coming in, by definition, by necessity, it is not an indication of profit pools shrinking. It depends on how the incumbents add value beyond the lower pricing to the end decision makers.
All right, we've dug deep, questioned everything and explored every possible angle. Now let me summarize everything in the most oversimplified way possible. The paint industry is a distribution business, not a chemical one. Moats in the paint industry aren't just about paint itself, they're about distribution. And cracking distribution is an all-out war that requires tech investments, keeping the dealers happy and keeping the painters happy. At its core, the decorative business may look like a chemical business, but it's actually a consumer product business. And in consumer businesses, the golden rule is simple: distribution, distribution, distribution. Second, this is the most intense competition the industry has ever seen. There's no if, no buts, no maybes about it. We have never seen this much competitive industry in the paint sector, period. Birlas have thrown 10,000 crores in the market. JSW Paints has announced 1,000 crore expansion. Existing giants are ramping up their own capacity. AkzoNobel might be leaving altogether. Astral, Pidilite, Nippon, all are doubling down on paints. This feels very scaringly similar to what happened in telecom sector when Jio entered in 2016. The entire industry went into chaos. Everyone was bleeding money and it triggered a massive consolidation. Only after the dust settled did Jio and Airtel started making record profits. If history repeats itself, the next few years in paints will be brutal. So if I was an investor, I would feel like maybe it's better to stay on the sidelines for now and let the chaos unfold and then pick my winners. After this whole research exercise, did I learn a lot about the industry? Absolutely yes. Do I feel more confident about how will this all play out? Absolutely not. But was this entire deep dive worth doing? 100%. And honestly, I don't mind leaving you all more uncertain than where we started. Because if you end up with more questions than answers, that means you're thinking about it in the right way. And that, my friends, is a job well done on my part. If you watched all the way till the end, I genuinely thank you from the bottom of my heart. Now, here's the deal. If you think I goofed up badly anywhere or missed something crucial, call me out in the comments. Seriously, I want to hear you out. No holds barred. And if you actually enjoyed this deep dive, don't hesitate to drop a like and share, because that one like might just help me keep my job and prove my boss that he was wrong. This is Kashish and I'll see you in the next one.